Think we're about ready to start. One thing I'm not sure about is where my picture is showing up here. Um, but we'll go ahead and get started. Appreciate everybody joining today. This is our Q2 webinar, and this one's called Dispersion. We're going to go over a few different things. We kind of look at some big picture stuff, look at the markets like we usually do. There's been a lot, go over dispersion and kind of what that is, what we mean when we're talking about that. There are some mixed messages. It's been a weird market so far this year. But let's go over some scenarios. We're going to go over three different scenarios, and these scenarios are they have the potential to be very consequential. They have the potential to push markets in a completely different direction. So we're going to go over those things. Um, Ask questions, please. You should have your questions down along the bottom. There's a Q&A and a chat. We'll be watching both, but if you could do a Q&A, you might have to look at the more button down at the bottom to get the Q&A, but we'll answer those throughout. So if you have questions, please go ahead and type it in, especially if it's related to that particular slide or scenario or what. So with that, let's go ahead and get started. Big picture, S&P 500. This goes back about 6 years, 8 years. And what we're showing is this stair step. You know, we've had every time, here's COVID. Every time we get a bull market rally, we see a bear market take it pretty much to the previous all-time high breakout. Pullback, breakout, sends it back to the previous all-time high breakout. Had a pullback this time last year, broke through it. We didn't get all the way there, a few percent, 2 or 3% below. And then we had this thing that just the market has taken off over the last kind of 6 weeks or so. Very narrow, very unique, very strange, but we'll talk about it a little bit. So we've been seeing these kind of stair step higher. So if we continue to see that, who knows? It could rally a little bit more, but at some point, some kind of pullback to test that breakout would be very good. It has been very narrow. The market has been strong, but in this kind of spike higher over the last couple months, it's been tech. That's it. So we've seen kind of tech weaken a little bit late last year, first part of this year. We've seen tech kind of come back and take the lead. Bonds also look terrible right now. We're seeing yields start to spike, and it looks like there could be some trouble in bond land. But let's go talk about dispersion, because one of the things that we try to look at is whatever outcome there is, if we look at a few different scenarios, what are the common themes? And if there's sort of this, status quo, and everything keeps going like it is, and we don't need to think about these bigger disruptive type of events. But there's just the potential for some things to be quite disruptive. So we're not going to necessarily look at the normal kind of scenarios. We're going to look at what happens if these big things start to happen. And dispersion should be a characteristic of kind of any next phase of the market cycle that we go into. Dispersion, we're not going to get too statistically nerdy this early on in the presentation, but we do need to touch on it. Basically, when we talk about dispersion, we're talking about a wider range of outcomes. Whether that's the potential outcome or looking back, difference in performance of different asset classes. So a wider range, a wider variation of performance. Increasing dispersion, when you see a large dispersion, that means that there's things that are just performing. The difference between the best performer and the worst performer is large. Decreasing dispersion or variation is kind of what we've seen over the last 20 years. So if we look back to the financial crisis lows in 2009, Here we are in 2026, so 17 years later, and everything has gone up. So the dispersion has been pretty narrow. When you look at a diversified portfolio, everything, every sector, every part of the equity market, stocks, bonds, commodities for the most part, everything has gone up. And everything, so a diversified portfolio has benefited from just low dispersion. Strong market benefits all asset classes. It doesn't mean that diversification works. It's a characteristic of a market environment with high correlations and low dispersion. That looks like it could potentially change. But when we're talking about dispersion, that's what we're talking about, is that in the past 17 years, pretty much everything has been positive, and it's just a matter of how much, tech did better than everything else, how much better. So there's dispersion in the level of upside performance a little bit, but we're not dealing with, 10 years of one asset class doing really well and another asset class being cut in half. That's what going forward when we look at dispersion, we're looking at not everything being positive. And so that I think no matter which scenario we kind of go into, if we go into one of these, I think dispersion is going to be something we're going to need to pay attention to. Looking at the market, we're going to touch a few slides on the market here. We're getting some mixed messages. This is a good chart for it. This is the NASDAQ 100 on the top. The red is the average average 52-week drawdown for those NASDAQ 100 components. So what this shows is, we had kind of a weakness. So we would not be surprised when markets are declining to have average drawdown of its components to increase. Here, the NASDAQ average component drawdown was about 26%, pretty healthy. It's a good, healthy correction just this year. We've seen that rally a little bit, but something interesting started to happen as we saw this divergence. So this visually shows fewer and fewer stocks causing the market to go up. More stocks are starting to roll over, starting about halfway up this move. We started to see the average drawdown actually start to decrease, even though the NASDAQ 100 was up about 10-12% in this move. So we're starting to see this dispersion where we're seeing fewer and fewer stocks on the upside and more on the downside. The market cap weighting, the big ones have been pulling the overall index up, but there's been more companies that have been falling in price. That's dispersion. Fewer things going up and more things having wide performance. Something we need to watch on, but this is a warning sign that probably this rally should roll over and maybe go back and test that breakout. Another thing we've been seeing, growth has dominated over the last 17 years. We are seeing growth versus value start to decline a little bit. We see, except for the last month, where we did see this rally and growth really outperform value. Other than that, when we saw it kind of peaked in the late fourth quarter last year, and we saw when this black line is going down, value is outperforming growth. So your more defensive, traditional dividend type companies versus your high-flying tech stocks. We saw the dividend companies really start to show some outperformance, and it's correlated. This growth value ratio has correlated pretty good to the 2-year, 30-year yield, that yield spread 2 years in advance. So the blue line looks at the 2-year yield minus the 30-year yield. So the yield spread 2 years ahead of this growth value ratio. So we've seen, what it looks kind of similar to what we saw in 21, kind of post-COVID. We saw the yield curve start to decline. This was a bear market. The stocks did the growth versus value did pretty well for the first move down here. Had was kind of choppy. We're seeing something sort of similar here. But then the yield curve started to compress and really caused a bear market. Value outperformed growth. You saw sell off in tech. That kind of followed the bond curve, the yield curve. Are we going to do that now? Maybe. One of the things we'll talk about are correlations. If this correlation, growth value to the yield curve, keeps up, then I would expect tech was probably going to start to sell off, or your value stocks, your dividend stocks really start to skyrocket. Maybe it's on the back of an inflationary environment. We're not sure, but if this were to happen, we would expect some value stocks to start to outperform growth stocks. Could be an opportunity there. Um, Positioning extremes. So if we look on the right side of this, have been schizophrenic this year. What this shows is basically how bullish or not the investors are. This has some call skew. It basically looks, it's a kind of an advanced way to say option buyers who are bullish, kind of what are they buying and how willing of a premium are they willing to pay? And you have this skew. So when you see this blue line higher, the market is kind of overly optimistic. When you see it go down, it's kind of in a more pessimistic, kind of a bear market stance. So it was pretty high back here when the market was rolling over. In the bear market of 22, 23, we saw very little call buying, which would make sense. It's kind of a bear market. Not investors aren't really all that optimistic. But we started to see that get kind of a more normal environment. And then over the last year, it's just really been all over the place. And it happens, but it says that there's some weird stuff happening, basically, is that the schizophrenia in the market is not good for sustainable trends. It is more characteristic of a choppy, up and down, directionless market that can be pretty difficult. So we need to keep an eye on this, but this oscillation of being optimistic and pessimistic in a short period of time probably is going to continue. And the effect of that is going to be confusion. If you're not in looking at the market a lot, when you see the sentiment flip around and you see prices, get real choppy, it just causes a lot of anxiety. And you don't want those kind of emotional reactions to steer you away from what you should be doing. So when we get these kind of extreme environments, it becomes relatively difficult. But I think that could be the environment that we get into. It's the easy money has probably been made, and I think it could get a little bit more difficult going forward. Still a lot of opportunities. US dollar, we talked about this over the last kind of 6 months or so. Overall, since last year, we've seen a big decline in the US dollar. This is another one of this. I3 Invest has come out with some really nice charts. I don't know if they hired somebody else, but they've been doing a good job. They're pretty clean and nice looking. But this is the US dollar and versus the 2-year yield, the 2-year treasury yield, 9 months in advance. So what this is saying, we've seen this kind of big decline in the US dollar since early last year. Going back further, it's declined even more. But since last year, we've seen a pretty good move lower in the dollar. This spike caused some commodity volatility. This little spike has caused a little bit of gold and silver volatility. But if this correlation holds up, we should see the dollar start to decline back to its low, probably through the rest of this year and into next year. That should support commodities. That should support international stocks. Might be difficult for US stocks. But then once this yield bottomed, we're really starting to see it spike. That would be, who knows, that at that point, next year. But we need to watch the dollar, and the dollar is kind of the tail that wags the dog. A declining US dollar is probably going to be good for commodities. What's not good for is bonds. We are really starting to see some bond routes happen. It's accelerated over the last week or two. But if we look, these are the 10-year yields in blue, the projected 10-year yield in 10 years in red. And basically, what we want to see is across the world, we've seen this spike higher. This is a pretty long-term yield chart, so it goes back to '06. But you can kind of see throughout the last those 10 years or 15 years from '06 to 21, 22, yields decreased. We're in a rising interest rate environment, and it's not just the US, it's across the globe. So bonds really do not look very good. One of the things it could be telling us is that inflation may be coming back. That's our first scenario. We've talked about this over a few years. We started talking about this likelihood, probably 6 or 7 years ago. But post COVID, and so what we're looking at here is inflation in the 1970s in blue versus today in green. Not hard to see the correlation. We saw a few different spikes. So actually, this one is showing two inflation spikes, but it's if it looks like this could be starting to happen. Iran war, seeing oil go from 60 to 120. It's been hovering in that 90 to 100 range, give or take, for probably 6 weeks now. That could be an inflationary impulse. If you combine that oil kind of price shock that could be temporary if it goes down, maybe it's just a little bit of a bubble, a little bit of a pig in the snake. It just kind of makes its way through temporarily into the economy, U.S. economy, or probably global economy. But if the US dollar is going to decline on top of that, and we have broader asset inflation, then this, could be the trajectory. Now, whether if you look over here on the right was the inflation numbers in the '70s, got up to almost 15%. Here, this was that same scale would put it about 10.5, 11% in today's world from, under 4 right now. That'd be a big change. That would not be good for equities, at least most equities. But we really need to keep our eye on this, because if this does happen, we're positioned pretty well for it. We've got increased commodity exposure over the last 6 months, but this is going to be the start or an advancement of a commodity super cycle. So let's watch inflation. In that inflation scenario in the '70s, we've talked about this quite a bit. It causes markets to be flat and choppy. A declining interest rate environment, declining inflationary environment, declining costs. That is good for companies. Rising costs, rising cost of capital, rising debt costs. Everything goes up when interest rates and inflation goes up. That tends to just put a wet blanket on top of the market. So we saw a very long period of time of a 0% return, and it was in a choppy 20 to 30 or 40% range that ended up 10, 15 years later at zero. Individual investors, our clients that are listening right now, you don't have the time frame for a 15-year 0% return. This could be very consequential to financial plans. So something we need to keep our eye on. This is looking kind of like the base case scenario. We've been talking about this for a while. And if we do get into this inflation scenario, I think a choppy market is what we're going to get. It leads to you have to reevaluate what you're doing from an investment standpoint. If you're with us, we're already doing this. But one of the criticisms that I think is ignored by this industry is diversification is not what it's sold to be. It's not just this beautiful miracle that creates goodness in investing. So if we look at the 70s market and we say, okay, what happened for a diversified portfolio? This is the kind of environment that you could fail conventionally. It's probably comfortable if you've been hearing about a diversified portfolio your whole life, especially the last 20 years when, attorneys and compliance departments have been running investment firms, especially the big ones. You just the lawyers want to just say, "Hey, diversify and don't sue us, please." Well, that's great, and you're probably going to fail. So, thank you, compliance officers of large banks. Um, Diversified portfolios lost money consistently for a long time. Stocks and bonds both struggle. If you have a portfolio of stocks and bonds, can you expect it not to struggle? Probably not. So what this shows is a couple different things, a couple interesting things. So the blue is 100% bonds all the way to 100% stocks. You can see at first, it's kind of like the more stocks you had, the better the less you lost, or the more you lost, the more stocks you had through this first decline. So here's the 100% bond portfolio in blue, less volatility, bear market performs as expected, right? But it's lower because bonds did not provide upside. Even a 100% bond portfolio in a bear market lost money. You can't rely on, this is relying on diversification in the wrong cycle. It doesn't work in all cycles. And then what we saw over here is it flipped. The correlations got inverted. So the bond portfolio started to do worse against the stock portfolio, and the stock portfolio was still down. So then we saw it flip around again and flip around again and then flip around again. So what happens is that these correlations change when you get an environment where that's very choppy, that has wider dispersion. Those correlations are going to change because performance is going to vary more. So if you have a one asset, stocks versus bonds, and they're both positive, then they're both negative, then one's positive, one's negative, that can have negative effects on the overall correlation. It also is very lazy from an investment standpoint because if your correlations change, then the risk in a 60/40 portfolio changes. So are you really 60/40? So if somebody's selling you a 60/40 portfolio and says it's 60/40 all the time, that's not what your risk looks like. Your risks will vary from 80 or 90% stock risk when correlations go up to, 90% bond risk. So there's just if we're going into this environment, diversification is not going to be your friend. And this is a good example. This is what happened this year. Correlation flipped unexpectedly without notice. And I guarantee your advisor did not, who is selling you the diversified portfolio, probably didn't even know this happened, much less did anything about it. But what this shows is the 10-year US yield flipped upside down to where down the orange line, if it goes down is a higher yield, up is a lower yield. So as yields were going down and this is correlation, bonds were going up in the orange line, so was the NASDAQ. So the purple is the NASDAQ. And what we saw is, this bonds starting to show risk and fall with yields going up. There was high correlation until whatever happened on that day. And here we started to see this massive divergence where it's just not anywhere close. Now, it can happen over time for sure. And when it does, it tends, not to be all that great, but it tends to be a reversal. So we saw the stocks decline yields decline, stocks decline, yields go up. So it becomes dispersion is not just looking at like the S&P 500 and saying, oh, well, the performance may be a lot different from year to year. Yes, that's the case. But the overall structure in the market and structure of a diversified portfolio can be turned upside down very quickly. So this is the kind of an inflationary environment is not something that you just have to save a little bit more and hold your nose. It has some real ripple effects that are that can be sort of subtle at first, but if you don't address them, they become massive. So fail conventionally or succeed unconventionally could be a theme that we hear for the next like 10 years. Recent inflation. So that was the 70s. We kind of looked at the 70s. Looking more recently, when we've seen, so what this shows is the S&P 500 back to 1996 on the top. That's the black line. The bottom line is the 4-month rate of change. So what we're looking for are these inflation kind of uh, impulses. So we've seen one now. So the inflationary impulses back in 2008, a lot of people don't remember, but oil in the summer of '08 spiked to over $100 a barrel. It stayed there for a short period of time, about a month, and then 2008 happens. So we've seen these kind of inflationary impulses happen, and it's coincided with at least near-term pullback. Now, the inflationary impulses in 2008, you know, we know what that led to. Inflationary impulses in 21, 22, this was a 30% bear market, 35% bear market. Doesn't look that big, but that was a big decline. We're starting to see it again. So it has these inflationary impulses definitely have the ability to be one of the factors that kind of tips the market over. Doesn't have to, but it could. If we do see some of the things that we're looking at now, though, maybe if we look at some of the recent developments, kind of overall in society, anywhere you see a lot of technology, you tend to have some offsetting, deflationary pressures. If you look at TVs, something that has all technology and no governmental influence, those TVs it's been deflationary for 30 years. The other inflationary cause is most often because of government spending. Well, corruption, which we're going to talk about a little bit. I mean, if there's billions and billions and hundreds of billions and maybe trillions of fraud that's just going out into the system, that causes inflation. You have a bunch of Somalians buying, Bentleys. That doesn't reduce prices. It may not have a major societal effect higher, but it's not going to help. But if you start to reduce government spending, which I think is going to happen, and you have more technology embedded throughout society, maybe the inflationary impulses aren't as long lasting. So, we have to look at today's world and say, okay, maybe this isn't a 10-year or 15-year inflationary environment. Maybe that's shorter, but we just need to watch it and see if it accelerates and see if there's some weakness that follows. So there's inflation. What does it look like? Equities highly disperse. We have a lot of dispersion. I would expect international to do well, expect commodities to do well. Do not expect bonds to do well in an inflationary environment. They'll probably do terrible. Commodities would be highly, highly bullish in an inflationary scenario because that's kind of where the inflation comes from. We are very much positioned for this at Ironbridge. We've got gold, silver, diversified commodity fund, agricultural commodities, We did trim some exposure to gold and gold miners today, kind of a support level broke. I expect that to probably go up, but if we further get reduced, that's fine. Equities to be determined, bonds bad, commodities good. Probably people are not very are ready. People are not ready for an inflationary environment. Scenario number two. Any questions so far? Hopefully, I'm not too technical here. Scenario number two is a bubble. We're not going to talk as much as I'm not going to talk as much about this scenario as the first one. This could be happening if we look at the last 6 weeks, an 18% move higher on the back of nothing, says we have the potential for crazy. AI has the potential to correlate with the tech bubble, the late 90s. This chart shows the 3 years leading up to today. So kind of looks at 1998, 3 years back and forward. So the blue is saying Netscape, which was sort of the internet darling, kind of the OG, if you will, dial-up broadband. If we look at what happened with Netscape price and it's just the NASDAQ, and then the Chat GPT saying maybe that's today's equivalent of Netscape. What's the NASDAQ going to do? So far over these 3 years looks pretty similar. 143% gain versus 139% gain over 867 days, which is 3 years. Oh, 10 years, excuse me. If this is the case, if we kind of reference this to zero and it's now at 150, if this is the tech bubble and this correlation continues, does it quadruple in price? I don't think so, but this is the kind of crazy that can happen. Bubbles seem like they would be fun, and they are for a little while until it just gets total pandemonium. So it sounds fun, but it's really quite sloppy and quite messy. But if this is the case, we have to keep our eye that markets could be irrational much longer than we would think. I don't think we're going to see this scenario, but the last month has said maybe. What are some other ways it says maybe we're not quite stretched as we were? This is looking at the NASDAQ 100. Another these i3 Invest charts, which is really good today. The NASDAQ 100% distance from a trend line. So if we say, okay, it's going to be a growth trend line. So it's not just flat, it's a exponential growth trend line. This is how far is that price from that trend line. This is way crazy. So if we look at, sort of right on the trend line, essentially saying that stock performance equals economic performance is a good way to think about this. The NASDAQ got almost 500% above its growth trend line. That is bubble. Right now we're about 50% above it right now, which is big. And that's where it reversed in the, post-COVID 21, 22, and the bear market started. But if we look back to 98, kind of after long-term capital management collapsed in 97, this 2 years got crazy. And, it's not that dissimilar. So if AI is going to have the same impact, we expect the same thing. If it's going to have the same impact, we should think about it as not having the same impact economically, having the same impact on market participants. That's what matters in a bubble. It does not matter what the fundamentals are. That's very, very, very important. If we're entering into a blow off top or a melt up or a bubble or whatever you want to say, forget about forget about everything else except price. Things will be disconnected, and that's part of the reason why it's such a weird environment. Is things don't make sense, and it doesn't make sense more as time goes by. So we just need to be watching for this. Again, I don't know that this is going to happen, but if it does, it's going to be really good until it's not. Dispersion, another area where we could probably see dispersion. If we see this bubble, one thing we saw in those last year and the last year of the bubble and then into the year after was massive dispersion. So what we show here is looking at the best S&P 500 stocks the year before the top on March 24th of 2000 and the bottom stocks for the year before. Then what the top stocks did for the following year after the bubble popped. And then what the bad stocks did the year after the bubble popped. So here we have dispersion, but it's dispersion in both an upside scenario and a downside scenario. Tech and these crazy companies, Applied Microcircuits, 1,300% in a year. The overall market was up 100% in the last 6 months, but these are crazy moves. Now, we've seen some of that in the last year in some smaller AI type stocks. But, when that bubble pops, they get crushed. And a bubble does not mean rising tide lifts all boats. Some pretty big companies, Waste Management, Raytheon, Humana, Mattel, Yum Brands, Lockheed Martin, Winn-Dixie, that reminds me of Florida, Office D. There's some big companies that just got smoked and got crushed in the year, down 60, 50, 60, 70% in the strongest market in the last 100 years. So dispersion, it looks like whatever scenario we go into, we're going to see dispersion. Even if it's a bull market, I think dispersion starts to increase. Again, we need to keep our eye on. So what's going to do well if we're into a bubble? Well, dispersion leads to reversion. So it sounds like Reverend Jackson, Jesse Jackson. Dispersion leads to reversion. So if you have a big performers tend to revert. You're not going to have these great performers are not going to just stay great performers. You're going to have to sell. Same way, these areas that are really get hit hard and get hit the hardest, those revert upward also. So you can see the areas that do well can quickly fall and revert back to the mean because it was really nothing of substance promoting that rise other than the emotional attachment of traders. So it can reverse very quickly. Same way, if people are chasing one area, chasing tech, and leaving these other areas behind, when that starts to flip, it can move very quickly. So there's areas you need to avoid, and there needs to be more activity. There's just more volatility within the market. So in equities in this scenario, they do fantastic and then they do terrible. Really not a good investing environment, but we'll deal with whatever we get. Bonds, not good. There's a theme there. Commodities should be pretty good. Crypto is probably pretty good if we're in this kind of bubble. So there's some common themes here. When we start to look at very different scenarios, you start to see some common themes, kind of float to the top. So there's AI. Corruption. We're not going to get I'm trying to not get political. I can't stand politicians. I think we've been stolen from our entire life. And I think we're finally going to see it. I hope. Um, but let's just look at a couple little things. Again, this is not Republican versus Democrat. I think both sides are in on it. I view it as criminals versus non-criminals. And the reason that this is a thing in portfolios and not just a politics is this feels to me like it's mortgages in 2006, that it's this big thing, that there's a lot of smoke and there's starting to be increasing smoke, which suggests that there could be fire. And it's uncertain to the extent of it. It's uncertain how big it is. And it's uncertain just what effect things may have because it's pretty unprecedented. Up to this point, it's been money out of the government to wherever. Now maybe not as much money out of the government, and less money from the private sector to the government, taxes. But let's just look at a couple things. Let's look at healthcare fraud. This is one example, and it just blows me away. LA County, this is hospice care. So, Medicare certified hospice care. This is coming from the federal government. This is money from the federal government, helped and aided by the states. In LA County, there are 1,923 Medicare certified hospice facilities. In San Diego, there's 74. LA County, 1,000, almost 2,000. You look at San Bernardino County, Orange County, Riverside County, Ventura County, Alameda County. I think those are all right around LA. What's that put? 2,500, 2,600, 2,700 hospice facilities. President Vance started a task force. They shut off funding for 800 of them. Less than 20 complained. Over $1 billion stolen in the last year in one county in hospice care. If we look at how that compares to other counties across the US, so I don't know, 1537. If you compare that to Houston, that's 238. So 7 times more. That's fraud. That's people are stealing money. And this is one county. It's theft. So, what are the potential outcomes? If it's big enough, I first of all, I don't think we're mad enough yet. I'm shocked that, first of all, the news is not covering any of it. We're pretending to think that this isn't happening. I don't understand what we're doing. But if we could stop a lot of this fraud, if we listen to Scott Bessent, the Treasury Secretary, who has told us we do not need to withhold as much taxes going forward. Either he's suggesting that we commit tax fraud, or the guy who is in charge of the IRS knows something. I think the guy in charge of the IRS knows something. If we look at payments, our clients, Social Security recipient, the average Social Security per month is $2,000 a month. The average illegal immigrant gets $5,700 a month. We're not mad enough. I just don't get it. So buckle up. I think it's all going to be exposed. The I there's a lot of potential outcomes from it, but I think people are going to go to jail. I hope people go to jail. And I think this is the big thing that nobody's talking about, or that very few people are talking about. And I think it has the potential to be the most important thing to your portfolio over the next year, 2 years, 5 years. So whether it dabbles into politics, whether I offend somebody, I think that is an acceptable thing to do the right thing for you. So let's watch what this is happening. What's happening there? Quantum financial system. This is related to that. If we do have, I think upgrades to the financial system are going to happen. It's just a matter of the speed at which it happens. Increased corruption. If we have an awareness of major corruption and it really starts to get uncovered and prosecuted, I think this happens very quickly. If it's more status quo and the corruption is not as widespread and it's nothing real major that is super influential, this may happen over a year or two period of time. But it does look like we are entering into a kind of a different financial system. Um, we'll have a different one. We'll have a dedicated webinar for this, or a dedicated video for this, because it's a little bit too complicated to get into. But essentially, what happens is this is a technology upgrade. If we look at bank wires, so if you're going to send a wire internationally, I've got a brother-in-law that lives in Indonesia. If I was going to send him $100,000, which I wouldn't, Ben, I love you. If you needed it, maybe, but if we're going to do that, it would take 2 or 3 days and cost 2 or 3%. It would go from Frost to this Bank of International Settlements. They do a currency conversion chart. They would sit on the money overnight and earn a little bit of interest. They would charge for a currency conversion. They would send a wire to an Indonesian bank. That bank would sit on it overnight and eventually get it into, the person's account that you're transferring it to. And in the whole time, banks made money on it, and you had no control over it. Sending a wire is sending a telegraph. Let me repeat that. When we send a wire, we're using telegraph technology. Telegraph technology going through wires on the bottom of the ocean. That's what happens when you send a wire. Crypto upgrades that. And what I'm reading, and we're not going to get into this too much, but about a 10 or 12 cryptos are likely to be backed by gold, silver, platinum, palladium to help with the transfers. There's been a lot of testing done using XRP, for example, something that we have in client portfolios right now. They've done $1 million transfer. It cost a fraction of a second, or cost a fraction of a penny, and took a fraction of a second. This is a big technological advancement, and it is way overdue, and it helps prevent and identify corruption. And I think this is going to happen. The Clarity Act got out of the Senate Finance Committee last week. The Federal Reserve has said banks can use crypto for whatever they want. SEC has gone through and done some approvals on crypto in various ways. The European Union has said they're going to start using crypto. Russia and Russian banks, China. I think part of the conversation last week was this, when Trump was in China. China and Russia are meeting this week. This upgraded financial system is one of the topics. India is joining in. Saudi Arabia is joining in. Amazon Web Services are putting all of their Amazon purchases on the XRP ledger. This is happening, and it's just a matter. There's real life use case, and I think this is something that could unlock kind of an entirely different asset class. I think we need to put my previous view on crypto has been that it's very similar to Beanie Babies. except Beanie Babies have the distinct advantage of having cloth to dry your tears when you lost all your money. A joke I like to make. That's not the case anymore. That could be the case with 95% of cryptocurrencies, but there are now about a dozen that are real and have real use case and are on the track to be used. So I think this needs to be a part of portfolios. Corruption what ifs. So if fraud is real bad, wouldn't eliminating it be positive? I mean, if you have no IRS, let's say it's really bad and it's so bad that you don't need the revenue from the IRS, that the government can be funded with tariff revenue and a national sales tax on non-essential goods. That could be really good for parts of the market. It could be really bad for other parts. So dispersion, that's what dispersion is. Healthcare stocks. So, there's vaccine risk and pushing COVID, a lot of fraud potential. Don't know if any of that's true. If it is, I would say Pfizer and Moderna may have a lot of risk. Healthcare stocks, if they've been benefiting from just the money printing out of the US government, I would say their revenue probably declines. If there's no IRS, consumer goods probably do pretty well. Amazon, we got a Costco buy. So if we have consumer spending that could be unleashed by tax rates being nothing, that's pretty good for the economy. It's probably inflationary, but it's dispersion. In this scenario, bonds look very bearish. Another common theme, commodities, another common theme look pretty bullish, and crypto would be extremely bullish. If it rolls out that there's really bad corruption, I think this system gets adopted very quickly, and I think things change quickly. So a lot to keep on the radar here. So those are three big scenarios. This is the last chart, by the way. So three big scenarios, all suggesting dispersion. So finally, to wrap it up, this is just a slide I took from our 26 outlook just to see, hey, this is what we said 4 months ago. What do we think now? US stocks suggest a positive year. So far, good. Overweight tech and commodities, so far, good. International stocks, international has outperformed US. Recent move, US caught up. We've consistently been adding US or non-US exposure on the back of a US dollar decline. Bonds, we've talked about. Short-term yields are stable. Longer-term yields are really starting to blow out. That has downward pressure on price. Not good for bonds. We want to stay short-term, high quality. Kind of avoid the rest. Private debt, there's been a lot of concerns about it. It's been overblown. It's been overblown. We really need to see economic weakness to see private debt weakness. Had a couple of, it was a CNBC scare last year. Private debt was a CNBC scare. So we have it. We like it. I think we're going to continue. I think it's continued to be a place that can be attractive. Commodities, gold and silver were extended. We kind of shared our last one. We shared something saying we're going to see it pull back, and that happened. We still like all the other ones. Copper, industrial metals, agricultural commodities are scoring pretty well. Private equity, I think, is going to continue to become more and more attractive. We have added a private shares fund that into client portfolios that is a somewhat muddied exposure to private equity, but still has a better risk return profile than small caps and mid caps. So we have some exposure there. I do think that there's going to be an increased exposure to private investments, but particularly private equity in the next 5 and 10 years. And crypto, I do think crypto could be becoming its own legitimate asset class. And I think there's a lot of different things that could come from it, a lot of different trading avenues. It could, using crypto in the way that crypto is potentially going to be used, you could trade some of it as a representative of something else. So I think there's some interesting sort of areas of the economy that we potentially could have exposure to. We may not want it, but I think as the financial system gets upgraded and as crypto starts to be more embedded into the bigger financial institutions and into the overall environment, I think it's going to open up a lot of different areas to consider. So we've got some positions there that we've been increasing exposure to. Okay, there we go. That is that. Any questions? I don't think so. Um, that was a lot. Thank you all for listening. Like I say, I think to wrap it up, bottom line, dispersion, I think is going to happen. I think we need to stay nimble, and I think that the transparency and the clarity of being able to see forward in the market of what potential returns may happen shortens. I don't think you can make a 5 year assumption very accurately right now. I don't think you can make a 1 year assumption all that accurately right now. I'm not sure that you can make a 6 month assumption very accurately right now. What that means, and I think there's two approaches. One approach is diversify and forget it and say, I don't want to deal with it. And I'm just going to keep doing what I'm doing. The proper way to do it is to continually look to be prepared for the current environment. You know, that means more turnover. It means potentially some whipsaws that we could get into an area and get out of an area. I think those are going to be characteristics. Those are going to be features of the next cycle, not a flaw of the next cycle. So I think we're going to just keeping looking at things, keeping a kind of a short-term horizon for now. Keep an eye on the bigger picture with these different scenarios and see how the data ends up maneuvering. So we appreciate you listening. Please let us know if you have any questions. We're going to post this on socials and the website, and we'll email this out to everybody tomorrow. But thank you all for listening, and invest wisely.